All right, today we are diving into something really interesting, a brand new class of investment that's just hitting the market. It's making a big promise to give more people access to some seriously sophisticated strategies that used to be only for the super wealthy. So let's pull it apart and see what it's all about.
You know that feeling, right? You've got some capital, you're ambitious, but it just seems like the most powerful tools, the ones that can actually make money when the market is falling, are locked behind a door you can't open. Well, that might be about to change.
So, to really get why this new development is such a big deal, we first have to understand the old problem. For years, the investment world has basically been split in two, creating this huge gap, what people call the missing middle. Okay, so on one end of the spectrum, you've got your regular mutual funds. Super accessible, anyone can get in, but they're pretty simple. They mostly just buy stocks and hope they go up. Then, way over on the other end, you have these elite clubs called alternative investment funds, or AIFs. These things require a minimum of 1 crore rupees. That's about 120,000 US dollars to even get in the door. They have all the cool toys, like shorting the market, but they're completely out of reach for most people. And that leaves this huge missing middle for investors who might have, say, 10 to 50 lakh rupees to invest. A lot of money, but not enough to get into the AIF game.
Well, regulators finally took a hard look at this gap and decided to do something about it. They've rolled out a completely new framework, which just became effective in April 2025, creating a whole new category of investment vehicle designed specifically to fill that void. And here it is, the Specialized Investment Fund, or SIF for short. The best way to think about it is like a hybrid. It takes the transparency and accessibility of a mutual fund and mashes it together with some of the powerful advanced strategies of an AIF. It is literally built from the ground up to serve that missing middle.
So, to see how one of these SIFs actually works in the wild, we're going to do a little case study. We're going to deconstruct a real fund that just hit the market, the QSIF Equity Ex-Top 100 Long-Short Fund. This fund is a perfect example of this whole new approach. Now, I know what you're thinking. That name is an absolute mouthful. But believe it or not, it's actually a perfect blueprint for what the fund does. Every single part of that name tells us something really important about its strategy. So let's break it down piece by piece.
First step, Ex-Top 100. What does that mean? It means the fund deliberately ignores the 100 biggest, most famous, most overanalyzed companies out there. Instead, it's going hunting for hidden gems where fewer people are looking, in the world of mid-caps, small-caps, and even micro-caps. The whole idea is that these less crowded corners of the market are where you can find some really incredible growth potential.
Okay, next up is the long-short part of the name. Now this is the fund's superpower. This is the tool that used to be locked away in those high-end AIFs. Going long is what most funds do. You buy stocks you think will go up. But going short means this fund can also bet against stocks, or even the whole market when it thinks things are headed for a downturn. It can potentially profit whether the market is rising or falling.
Let me paint you a picture of how this works. Let's say the fund manager is holding a bunch of great mid-cap stocks, but they get a feeling a big market correction is coming. Instead of just selling everything in a panic, they can use up to a quarter of the fund's assets to short the market index. Then, if they're right and the market tanks, the profits they make from that short position act like a safety cushion, helping to cancel out some of the losses from their other stocks. It's a really powerful tool for managing risk.
But look, having a superpower like this is never simple, right? It's a double-edged sword. These advanced tools create some incredible advantages, but they also bring some very real risks to the table. Let's dig into the trade-offs.
Okay, one of the biggest, and I mean biggest, superpowers here is taxes. If you were running this same long-short strategy in an AIF, your profits would get taxed as business income. We're talking over 30%. But because this SIF is structured as an equity mutual fund, the long-term gains are only taxed at around 12.5%. That is a massive difference that goes straight into the investor's pocket.
And it doesn't stop with taxes. Check out the cost difference. This SIF charges an annual fee of less than 1%. A similar AIF, they could easily charge you 2.5%, plus a big cut of the profits as a performance fee. Over many years, that cost difference has a huge compounding effect, meaning way more of your money stays working for you.
So, you're probably thinking, okay, it's cheaper, it's way more tax efficient, the returns must be incredible, right? Well, this is where our story takes a bit of a turn, and where the risks really start to show themselves. Since this fund launched just a few months ago, its return has actually been negative 4%. Yeah. It had some seriously bad timing, launching right into a market storm that put its whole defensive strategy to the test right from day one.
Now, this performance didn't happen in a vacuum. This fund was basically born in a hurricane. Right after it launched, the market hit a rough patch where something like 70% of the top 500 stocks were losing money. So while that negative number doesn't look great, its ability to go short probably saved it from a much, much deeper loss.
All right, let's pull all these pieces together. We've seen the powerful engine, and we've seen the rocky start. So, the big question is, who should even be looking at an investment this complicated?
So the argument for this fund is pretty compelling. You're getting incredible tax efficiency, you get to play in a less crowded part of the market, the costs are way lower than the alternative, and it's run by a team that really knows their stuff when it comes to these complex tools. Oh, and unlike AIFs that lock your money up, you can get your cash out any day you want.
But the con list is just as serious. First off, it is officially classified as very high risk. It's brand spanking new, so there's zero long-term track record. You're mixing the natural volatility of small companies with the complexity of derivatives. And, well, right now, it's losing money. This is absolutely not for the faint of heart.
So here's the bottom line. This is not a replacement for the core, stable part of your portfolio. The best way to think of this is as a satellite holding, a small, high-octane piece you might add for a different kind of growth potential. It's really only for seasoned investors who can handle a lot of risk and are willing to lock in for at least 5 years.
The arrival of these new SIFs is a really fascinating development, for sure. But in the end, it leaves you, the investor, with a pretty critical question to answer for yourself. Is the potential reward of getting access to these powerful, tax-smart strategies worth the very real risk of jumping into something new, unproven, and potentially very, very volatile? That's the trade-off you have to make.